world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Are retail investment offerings fit for purpose? Historically characterized by high fees and questionable objectivity, retail investments are going through a transformation as the likes of Robinhood, Betterment, Scalable Capital, and others bring compelling digital offerings to market. Richard Theo is the co-founder and CEO of Wealthify, one of the UK's leading robo-advisors. With a background in technology and computer science, Richard started Wealthify in 2014 to take advantage of the then relatively nascent digital investments market. In 2017, Aviva acquired a majority stake in Wealthify to offer its services to their existing customer base. It feels like we've only just started down the path of retail investment transformation. We've made great progress, but we're still miles away from truly revolutionary offerings in the space. Just like in digital banking, there are a handful of players vying for primacy, and it's fascinating to watch it unfold. Have a view on this subject? Let us know on Twitter at Rebank Podcast, on LinkedIn, or on our website at bankingthefuture.com. Thank you very much for joining us today. Please welcome Richard Theo. Richard Theo, welcome to Rebank.
Pleasure to be here. Looking forward to chatting.
Yeah. So tell us about Wealthify. You're the founder and CEO of Wealthify, right?
Yeah, that's right. I'm a co-founder, I suppose, is a more accurate term. We set the business up, originally formed it back in 2014, built the right team, developed the technology, and then we launched in April 2016 to the public. We really set out to democratize investing, so make investing accessible to everybody, really. Prior to that, it was the province of the elite, and often overpriced and expensive. And we sought to sort of challenge those traditional norms and make it something that anybody could contemplate doing. Lots of attributes to make it accessible to people, such as the ability to take your money out without notice, and those kinds of features.
What's your background prior to Wealthify?
Oh, I'm a software guy by origin.
Right,
I went to university and studied computer science and then did a PhD in computer networking and spent the early part of my career in software, sort of hardcore software, if you like. Then I had a sort of reached a junction in my life back in 2009 and set up a business called ActiveQuote, which is in the price comparison world. Does price comparison of life insurance, health insurance, and income protection insurance. And it's not a name that everyone's familiar with, but we power some of the leading brands. So Go Compare, Confused.com, Money Supermarket, YouSwitch, with those types of products. And actually, little known fact is Wealthify was originally conceived within ActiveQuote as a sort of product idea to sort of try and do something new and different. And then we realised the potential, so we spun it out and set it off on its own trajectory, and then later I went with it, feeling the need that it needed a full-time sort of leadership, really.
Interesting. Okay, so I would love to, from the standpoint of Rebank, so we're a fintech podcast, right? And so we bring a bit of a finance or banking or financial services angle to it. So, if you weren't a career investor before starting Wealthify, I'm sure you've cut your teeth along the way. Maybe you could kind of paint the picture for us, for the listeners, maybe those who aren't even from the UK. Investment space, specifically the retail investment space. What if anything is wrong with it in your view, and what are opportunities that likes of Wealthify are capitalizing on?
Yeah, so there are a number of things wrong with it before, and they're still largely wrong with it today. And the first of those things really is that today, people's first step on the investing ladder tends to be that somebody's told them that there's this great stock and that they should go and buy it. And it's just about the very worst thing you could ever do starting on the investing ladder, because investing in one stock, even Warren Buffett, the sage of Omaha, America's greatest ever investor, arguably can't pick one stock and say, I can be sure that that's the best single place for my money. So it's been known for a long time that the best thing to do investing-wise is to diversify your risk. So that means investing in plenty of things and, geographically spread out, possibly, and even into different asset classes, so not just equities, but bonds, property, and other things too. So when someone invests online with Wealthify, we do that job for them. We build them a portfolio that invests them in a multitude of things and gives them a diversity of risk. And mostly what we invest in are passive things, so things that follow the markets. We're not trying to pick single winners here and there because that's fraught with risk. So what we do is simply ask people, what's their investment style? Do they want us to invest cautiously for them or more adventurously for them or anywhere in between? And then we build them a portfolio of assets and they can manage that online, withdraw their money without notice. And best of all, to appeal to the sort of younger generation, you can start investing or try it out with as little as £1 to get on board. And then if you're comfortable with it, you can invest more later.
So I'm particularly interested, and I imagine much of the audience is too, in kind of the understanding broadly the layout in the robo-advisory space, the Betterments and Wealthfronts in the US, the Scalables, Nutmegs, Wealthifys, others in the UK and Europe, and no doubt many others that I'm less familiar with in other parts of the world. I would be interested in your view, and perhaps this is forms the basis of the conversation, as to the way that you expect the industry to evolve. Right right now, we're seeing interesting stuff. Robo-advisors bringing down pricing, providing diversified, often passive portfolios to people, which, as you say, offers them generally much better and more sound investments than single name stock picking on execution only brokerage platforms. Is it the current robo model is it sufficient to meet the broader needs of the retail investment community, the average employees, saving toward pension, saving toward retirement? Is it a freestanding piece of a larger whole? Do you expect platforms like Wealthify to be evolving and maturing over time to pick up additional components of more comprehensive wealth management, financial management piece that, in a way that they don't yet? I'd be curious to know you as a CEO of a company like this, where we go from here.
Yeah, indeed. So I think with Wealthify we're trying to build the product out so that it can serve your investing needs at every stage of your life. So there are different stages. There's the starters who have little knowledge about finances and need to learn before they sort of chance their arm and start making their own decisions, taking risks. So that's what we're really good in that space. Mid-stage life, people have goals around saving up for a deposit for a house, buying a car, getting married, dream holiday, all those kind of things, and we're very good for that kind of stuff. But we certainly will go more in the direction of people's retirements as well, because that's where a large amount of money is invested, and because it's a much longer term horizon for investing, it's a safer bet. It can ride the ups and downs of the markets in the meantime much more safely. So we'll certainly evolve in that way. In terms of the way the market's going, there's an underserved population today that can't really afford to get financial advice from a proper advisor. Either that, or they don't want to pay the fees, which can be quite high sometimes, or simply the financial advisors don't meet the thresholds that financial advisors require in terms of wealth to go on board and get that. So the online space is certainly emerging and growing in terms of the breadth and depth of online advice, and we'll continue to see that happen. I think the challenge for the industry is that some of the things we've seen launch recently that are doing much more sophisticated online advice are having to ask 20 to 30 minutes worth of questions, and that doesn't typically fit well with online. Although people perhaps want that advice and that steer on where to go, the truth is they also don't want to sit for half an hour answering questions to boring questions on a website. The attention's, it's very easy to flip from one website to another and people lose. So there's a very big question about whether that really ever works in that context. Wealthify was set up more to address people who recognise the problem and simply recognise they need a good place for their money where it will be well managed and well invested, and that they make their own decisions about that, really. I think.
Do you think that's sufficient? Are retail investors sufficiently educated to be able to make to manage their own investments, i.e., working with someone who's offering guidance as opposed to regulated advice?
I think, like I said right at the beginning, I think the biggest risk of all is DIY investing. It's people trying to pick stocks, and it's a human cognitive bias to believe that we can succeed at that game in the same way that we love gambling, but we throw 13 billion of our money into the gambling industry every year in terms of the difference between what we gamble and what we receive back, which is just a staggering statistic when you consider it. Actually, it's about £200 per £300 per head of adult population in the UK every year thrown away in that direction. Far better if people did that every year and invested it. I mean, the other thing that's a little bit of an important point that we make is, what the robo industry is doing is also reducing the cost of getting that good quality investment management. So you could have that before, but you'd pay 1.5-2% for the privilege. The robo or the online investing world has reduced that. And actually what that does over the long term is really quite significant. If you look at the erosive effect of fees over 20 years and 30 years on investments, actually you can double and triple your outcome over a long period of time by just simply halving the total cost of the fee. Because, if on average markets rise 4 or 5% a year, and that's what you get, and take out 1 or 2% of that and compound that over many, many years, and look what happens.
Yeah. So you come at this from, as you said, from a software background and not from a finance background. Pricing as a percentage of AUM is traditionally the way that the market has worked. Do you think that's the inevitable future of investment management also, or do you think people come to market with different pricing models?
I suppose the big question there is whether you can acquire enough customers that you can look to make your money through other ways of cross monetizing your client base. And we see in the States, where the market obviously is 5 or 6 times larger, and probably a few years ahead as well, that some of the fees have come down. Oddly enough, though, the evidence that we see is actually fees aren't at the front of people's minds. As long as they're getting a good service and they enjoy it, the fee is secondary. So
which is important, right?
Yeah,
because I think if you, I guess part of my concern about where we are with digital investments at the moment is if it's all fee focused and we end up moving increasingly to passively managed, which I'm a huge fan of, but guided as opposed to advised investments that continue to, I think, to an extent, be seen as kind of a standalone piece, i.e., you've got some savings, throw them in this diversified portfolio, and we'll revisit it in X number of years, which is great for retirement. I'm not sure how it fits into the the kind of day-to-day living of life, financial management in the context of people with children, with friends, with homes, with bad things happening, with all sorts of life events that influence what people should and shouldn't be doing to maximize their long-term wealth. I think, I hope, and I'm sure that Wealthify is a part of this, and it sounds potentially, and this is something I want to pick up on, your relationship with Aviva, which seems to, at face value at least, represent a different way of looking at where investments sits, i.e. Alongside other components of one's financial life. Maybe it's a good time to pick up on that. Can you tell us about the relationship with Aviva?
Yeah, absolutely. So so it's quite a long road to profitability in our market. We need what they call in the venture world patient capital, because if you look at that little fee that we're charging and you look at the average investments people are making, it's going to take quite a number of years, and the press have loved to criticize our industry and highlight the losses that some of the firms have made, but that's why you take investment to fund the early losses, because you have a vision and the business plan shows that down the line there's good money to be made. And I think that's the vision that we all have. But last year when we were out looking for venture money, it was proving quite difficult, and we sort of decided that we'd talk to some strategic investors who could bring both money but also potentially clients. And then we got into a conversation with Aviva, who didn't at the time have a sort of simple investing proposition for their client base. They have a platform where you can self-select funds, and they have, they're one of the largest pension providers, particularly in auto enrollment in the UK, but they didn't have an elegant, simple investing solution. That's what appealed to them about Wealthify, and what appealed to us was they have 15 million customers who buy all those other products from them in the UK to whom they can offer our service. And in a world where the path to profitability looks quite long, it's very attractive to find a path to getting access to large numbers of customers and to capital. And so we embraced that partnership. And in many ways, that fulfills the very promise of fintech. Fintech companies are either great brands that emerge as new household names, or companies that provide a service that shake up the big guys and make the big guys stand up and pay attention, and deals like that arise. And I guess our deal with Aviva represents that model. Yeah. It's very early days, but we're working closely, and it's a great partnership with some really great people who are very open-minded and not at all corporate in the way that they work with us. They empower us to still run our business very independently. And it's exciting times.
Yeah. No, well, that's excellent. And you make the, I think, fair point that a lot of digital investments firms have kind of been slammed in the press, and numbers, analyst figures, and if you kind of crunch the numbers yourself, it looks like maybe a 400 to 600 pound cost of customer acquisition. So how do you turn that into a profitable business without burning through all your venture capital before you get there? And I think largely, at least, it seems like the consensus is you try to, especially if you're starting with a digital proposition that appeals to younger people, help them get comfortable with what they're doing, build trust with them, and grow their assets over time, encourage them to save over time, effectively growing your AUM over time. I think this is very relevant in the context of the present day in the UK, where we're still, I think, early in the shift from defined benefit to defined contribution pensions. And I think you made the point earlier that pensions becomes probably an increasingly important part of what Wealthify does, and indeed many other robos. How do you think of the pension space right now, and how relevant is that to you guys at Wealthify at the moment?
Yeah, well, we're obviously, as I said earlier, really interested in that space. I mean, the whole defined benefit, the DB, which obviously stands for defined benefit pension, was kind of the way pensions were originally done, and people should have seen many years ago that they were storing up this enormous problem, that they were promising people a particular amount of money for the rest of their life at retirement, and they were setting aside money to fund that. And when markets didn't perform the way they needed for the investments in terms of where they were placing that money in the meantime, they were storing up this enormous gap. And there are many stories of catastrophes where companies have had to end up trying to fund the shortfall. So companies today don't do defined benefit pensions broadly. Nowadays we do defined contribution pensions, where people put a set amount in and they get at retirement whatever that pot has built up to and grown to in terms of the growth of the investments. And of course there are companies out there who are sort of lumbered with a defined benefit liability, who are trying to persuade their staff to convert to defined contribution pensions, and offering them money sometimes to sort of get them to agree to make that leap. So I think the future obviously is defined contribution pension schemes. Some people today, the evolution of auto enrollment pensions occurred in the last 5 or 6 years. A brilliant thing. But actually sometimes that's not enough, and people want to put additional money aside and take the advantage of the fact that the government give them 25% back when they put their money in a self-invested pension plan. And plenty of people see that opportunity and want to take that. There's also, of course, plenty of people in the UK who don't have an auto-enrollment pension. The self-employed, for example, 5 million of them don't have the luxury of that because they don't have an employer. It's them. So they're an interesting opportunity in that space. So yeah, we're very excited about pension products, and I think the other thing that's worth throwing in is also, there will be plenty more innovation. We innovated in 2018 with ethical investments, which is something that appeals very heavily to the younger audience, and we have plenty of ideas how to keep these products interesting going into the future, and to differentiate Wealthify from other players as well.
I'd be super curious to hear a bit about what your experience has been delivering a digital solution around complex subject matter to people, many of whom, based on the segment that you guys most serve, probably won't have been particularly familiar with investing beforehand.
Yep.
I mean, I don't know. Are there any lessons that stick out in terms of communication style, what's important, value set?
Yeah, absolutely. I mean, look, it is a big challenge because actually, if I stand in front of someone and have to sort of talk them through what we do, it's 5 or 10 minute conversation really to sort of fully explain the whys, the advantages, the risks. And when you have something that takes 5 or 10 minutes to explain verbally, that's a real challenge to turn that into something you can market and put on a billboard and get people interested. So there are certainly some big challenges, and we have a problem in the UK that actually, given where we are in the G7 as an economy, we rank unfortunately far behind all of those other countries and many more beyond in terms of our financial literacy and education. So you're absolutely right. People don't really know. But I think we remain confident that as this market emerges and more people become aware of this, then it's in fact no one company can change the world and educate a market. It takes multiple people coming into a space to actually succeed in educating a market, and we believe with time that will serve us well. Obviously, it doesn't help to have markets do what they did in 2018. And
maybe that's a great example to pick up on. So, okay, the past 90 days or something have been pretty crazy. What sorts of contact have you received from customers, and what have you found to be the most effective ways of describing what's going on?
Well, tragically, the best time to invest is when markets have gone down. But tragically, the lack of education in the retail space means people panic. So when they see the value of their investments go down, despite the fact that we've warned them, that capital is at risk, your money can go down as well as up, they panic and worry, and that does drive an exit of an amount of money. Nothing particularly terrifying. It's not like we've seen any significant proportion of people leave, but it's certainly higher during the months of November and December than we'd had any time since we launched, really. And again, that's all about education. But it's also about making sure that when people first invest, they invest at a risk level that's appropriate to their circumstances and that their time horizon works out. And so going back to your original question, how do you deal with that? Well, we just have to keep explaining to people, don't panic. And we use communications that show people sort of historical markets. When you look at the long-term trends of markets, what feels like a horrible decline today looks like a relatively small blip in the long-term curve, and people get it. But it is hard persuading them that now would be a good time to top up rather than withdraw, and invariably people do. And I guess that the challenge for our market has increased slightly in the last year in that interest rates have risen, so savings rates have risen consequently as well. And so where 2 or 3 years ago the differential between what people could get from a savings plan and what they might get from investing was high, actually now that gap has closed, and actually long-term bond rates, which form a large part of what we do in our investment strategy, particularly at the cautious end, are low, running a very low in historical terms. So it's quite hard to to show that differential and that advantage, and to encourage people that it's worth taking the risk if they can to get that extra gain, if you like.
Are you, so, bit of context, I don't know, 3 to 5 years ago, when more in some cases, when kind of the first robo-advisory firms were getting set up in Europe, in the UK specifically, there was I would say broad lack of offering to someone with between, say, I don't know, 0 and 30K of savings, and perhaps it goes up higher than that. There's been talk and some early moves of high street banks moving back into the retail investment space, having pulled back due to compliance and regulatory concerns a few years ago. Is that a trend that you guys are monitoring? Something you expect to materialize? Yeah,
definitely. The banks are absolutely moving back in. They seem more interested in advice-based solutions necessarily than just simple investing services or non-advice services, and that's because they do offer advice around a multitude of other things as well. So yeah, we're seeing the re-emergence. Some are doing it digitally, and some are getting back in safely now that the sort of ground post the sort of the FAAMR reviews sort of settled down and they understand what's going on.
And maybe another question related to kind of industry dynamics. It'd be interesting in your view of the kind of the self-directed investment platform model. So in the UK, Hargreaves Lansdowne is the biggest player.
Sure.
10 plus years ago, he was buying single name stocks on like E-Trade or Schwab kind of online platforms, which are still very much in use. I don't know, how do you think about Wealthify's model as opposed to an execution only platform like that?
Well, I mean, actually, Hargreaves offer a full range of services, don't they? So you can go and get full advice over there. They have fund supermarkets. They even have simple investing solutions, and you can trade. So I mean, they have a sort of broad array of services, which is inevitable for a company that's done that well over many years and has a very, very strong brand and a strong place of trust in consumers' minds. I think our view of them is we're not particularly worried about them in that they often, when people offer too many things, they lose that essential simplicity that we know we have. We will stick rigidly to that. I would challenge somebody who's not really an expert to visit their website and really know where to go, and possibly end up having to pick the phone up and go into an advice process to sort of actually make that decision.
Where maybe to wrap up, kind of stepping back and thinking big picture, where do you expect the robo space, the digital investment space to evolve to in, say, 10 years from now?
Sure. Well, I think the figure is that there's roughly $1 trillion of cash in the UK, and that's ignoring all the money already invested. I think as people become more and more aware, particularly following MiFID early this year, of the sort of high fees that some people are charging, we'll see a shift of funds moving across. There's a well talked about transfer of wealth occurring generally in that the previous generation are sort of reaching the point of retiring or end of life and transferring wealth to the younger generation, who have to make a decision about what to do with that. And so I think it might take longer than everyone had originally hoped, but we still remain entirely confident that this market emerges and is an important part of the financial services landscape. There are some regulatory challenges. We don't find the regulatory climate very supportive today, but we talk with our regulator closely to help sort of explain the point and the need for services like this in terms of giving people that essential first step so that we can improve financial literacy in the UK and get people thinking about their long term rather than spending their early life just spending.
Yeah. What are the regulators' main concerns?
The regulator doesn't have concerns. It's just that some of the rules that are enforced today around, in particular, suitability, were written really for a prior age and for fully advised services, but because the rulebook hasn't been written and has been subject to EU sort of principles, they're sort of kind of stuck with some rules that are now applied to online low-cost investment services, but they're probably not appropriate and they're a bit overkill. So we all have to ask rather too many questions about understanding people's attitude to risk, to make sure that the risk they chose was the right one, to check that they can afford to make the decision they're doing and can afford to bear the loss. And so lots of things that are arguably overkill, particularly for someone who's just wanting to invest a relatively small amount of money. After all, they can go and buy a lottery ticket without questions. They can go and gamble it at the bookies without constraint. They can, God forbid, go and buy Bitcoin without any requirements for those things, and a multitude of other things. Some slightly less crazy than the examples I've just given.
So you don't offer a crypto ETF?
No, I have to say right from the very start, when people approached us and said, "What's this Bitcoin thing?" I will proudly say I told everyone to avoid it like the plague. It was very clear to me right from the start that something that has no underlying base value in terms of some asset that underlies it has enormous risk associated with it, and whilst it was predictably going to grow through the nature of trading and people taking risk and seeking exorbitant gains, it inevitably did what it did. And I don't think, I still today wouldn't recommend anyone contemplate that route, really. It's just a product that's not needed, by the way, and likely to get heavily regulated more and more with time, just because it's also become more than a legitimate asset class. It's become a way for financial crime to be perpetrated and money to be passed around the world, hidden from barriers, and governments just simply aren't going to let that happen in the longer term. They're moving slowly because they never want to stamp on something before they've looked and seen whether it's got some potential, and they don't really like doing things that people are enjoying using. They don't like to stamp it out because that's not a popular thing to do. But yeah, that's my view on that.
Yeah. All right. Richard, where's the best place for people to learn more about Wealthify and connect with you guys?
So download our app on if you search up Wealthify in the App Store or on Android, you'll find us quite quickly. Or Google Wealthify, and you can sign up in 5 minutes on our website and manage your money through the app or the website thereafter. Or call us up or chat with us online if you've got any questions.
Excellent. Richard, Theo, thank you very much for joining us today.
Great pleasure. Thanks, and good to talk to you.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.